ground and work with a developer. See, on the return expectation is late teens to early 20s. That's the return expectation, which is more than the equity returns that mutual fund has done in last 10 years. If you take up funds from 2010 to 2020, the best performing funds will be early teens. Here we are trying to generate returns which are significantly higher, which would mean that the governance and involvement has to be equity-like. Structure could be a debt-like. You can have protection which are debt-like. So I think the asset management part of it, so I would say strategy, team, and then the bottoms-up approach of managing the asset as if you have done an equity into the project.
I mean, that is a great segue, Irfan, coming into you. I think I can rattle out a lot of statistics on Swamih Fund on your behalf, Irfan. 60,000 units funded, 9,000 delivered over the next 3 to 4 years. The balance are going to be committed. Fantastic. Certainly in the NCR region, Irfan, there is a lot of confidence building that has happened with the Swamih Fund, bringing in the money to be able to complete the homes which had been left unconstructed, incomplete for years. Not only that, those homeowners got their homes, the confidence within the real estate sector has really improved, and that the excitement that comes in with the way that Swamih has been able to brand itself with the developers is amazing. The point that I wanted to pick up, Irfan, was really where Sharad left on this asset management. I just want a little bit understanding on Swamih, the way that you asset manage, because I think your asset management definition is perhaps different to some of the others' asset management. Sorry, you are on mute, Irfan.
Hi, Anuj. The professional hazard of speaking to you every day is you take away all my talking points, right? So you know the score, you know all that. But that aside, like I said in a webinar yesterday or a few days ago, what really matters to us is we are trying to do only two things. One, provide adequate capital at the start, and two, to ensure that the entire capital goes into the project we are funding, right? That might sound so simple. That might sound obvious, but there's a track record of funds not being used in the project, especially that part. That funds have been, diverted either for other projects or diverted for personal reasons, or whatever the reason, it is a diversion, and the money collected from home buyers in a particular project have not been used in that particular project. And that's where Swamih tries to be different. That's where we've adopted a drip irrigation method. We are extremely liberal when it comes to sanctioning funds for a project, and we have this, we are very tight-fisted. We have, all our controls are to ensure that funding is done, to the extent possible. So the first rule we start off with is we'll be doing reimbursements only. We will be funding reimbursements after we have checked that those are expenses that have been done for that particular project. And how do we ensure that? Instead of having a PMC that visits a site once a month, once a fortnight, or once a quarter, we have a PMC representative that is stationed at the site. So we have a daily report on expenses, inflows, material coming in, labor mobilization, etc., etc. So we are in a better position. We are in a more informed position to fund reimbursements of expenses that have happened at the site. But that's just one. Does it mean that we do not do any kind of advance funding? No, we do advance funding as well, because that is the nature of the industry. Advances are required so that the developer can get substantial discounts, or for customized products, it is an industry norm to give advances. So we give advances and we keep a close tab on it. What we do is we have more than one level of control. So one is at the PMC site itself. The other is within the team. So we have one individual looking at maybe 2, 3, or max 4 projects only, and then looking at all the invoices that have been cleared by the PMC representative, checking them against the technical due diligence and the cost estimates that we had received before we actually invested in the project, and only then clearing them. And same rule followed. Discourage cash expenses, discourage advances encourage banking transactions, and keep a tab. So that's one. The other level that we've gone to is all the payments are done directly to the vendor. All the payments are done directly to, if it's a rehab project and there are tenants, all the rental payments are made directly to the tenants. All the payments to the various suppliers are done directly. All the employee expenses, all the salaries are paid directly into the employee accounts, right? So at any one point in time, and that is possible today, it might have been difficult earlier, but with wire transfers and the trustee doing the wire transfers, it is easily possible with some level of effort. So all the expenses are paid directly. Very little flows to the developer's account. In fact, in most cases, except for tax payments, where the money is deposited into a developer's account, and the next payment is released only after we get the challan or the invoice or whatever for that payment to show that the payment has been done. So in a way, our team acts as a project CFO, not as a lender. And we are in, they have a complete understanding of, what expense is required, where is the expense currently being funded, what next, and so on for every part of the project. So it's a project CFO ownership kind of a role, and that's asset management for us.
Hey, Irfan, I don't want to bring Vipul on this one. Vipul sounds like very intense asset management, very involved CFO role, as Irfan put it across. What would HDFC Capital do in this part compared to what Swamih is doing? Is it similar approach that you also follow?
Very, very, very similar, except that we have a graded approach. We divide all our investee companies into 3 grades, and we have specific asset management approach depending on the risk that we attach on the development cycle, because we invest across the entire development cycle. Sometimes the granularity of what is the technical aspect of the project may not be so relevant, depending if it is significantly ready or if it is unlaunched, and so on and so forth, because we follow a bouquet approach. But yes, how Irfan very beautifully explained, I can't explain that way, but yes, we are doing about that for what we say is our high risk investments, which is about 70% of the portfolio. 30% of the portfolio, we would have a slightly moderated approach.
And then Vipul, very interesting, because this wasn't the case earlier with many of the other funds, who had come in. I'm talking way sort of 2005, 6, 7, that sort of genre. At that time, you would never have this kind of involvement where you would actually be sitting on top of the developer. At that time, it was largely a check that was written and then managed through spreadsheets. Very, very, very different approach. Irfan, just coming back to you, a couple of more questions I want to ask. Has the deal flow increased, decreased, remained the same during this COVID time?
So the good news for the rest of the industry, the not so good news for us, is that the deal flow has actually decreased, right? We are a distress fund. The distress in the environment has significantly decreased since the time that we were launched in 2019. So, that was the dark age for, just at the start of 2019, when, NBFCs were going through a fair share of trouble, more than a fair share of trouble. Most of the funding for real estate had happened through NBFCs, and that supply line had got throttled. There were a large number of unfinished projects, and that's when Swamih came in. And, because I live, breathe, and eat Swamih all the time, I like to believe that Swamih has a large role to play in reducing the stress levels in the industry. But this is an objective opinion from someone who works in the Swamih fund. Instead, what I can give you are stats rather than an opinion. So we've done about 108 deals, like you mentioned earlier, right? Just let me give you a context to 108, right? 108 is more than the number of deals done by the rest of the PE residential industry. So just one fund has done as many deals, or probably more, than the rest of the residential real estate industry in the last 2 years. And that's how, that has reduced the stress in the industry. So that's one. But it's not just this. I mean, the government has taken, several steps to be proactive here. So apart from Swamih, even the emergency credit guarantee scheme that was introduced helped reduce a lot of stress from the developers. And then various state governments, reduced stamp duties in various important markets, and that itself also helped reduce the stress. In fact, what happened was a culmination of a few factors, right? The fact that interest rates were at a historic low, home loan rates, and therefore affordability was at its best, and COVID, inspired people to not just inspired people to buy larger houses and better houses, because a home wasn't suddenly a place where you spend only the night. You spend your entire life here, the day and the night. But COVID also reduced the supply in the market. So that again helped the developers. So all that is good news, and that is especially good news for the larger developers in the market, who got not just a bigger share of the pie in terms of larger number of sales and better and customers walking in, but also got capital both from private equity as well as public equity sources. Right. So all good for the larger developers. I think the situation deteriorated or worsened to a very large extent for the smaller developers. So they have been left out of the market. It is not like the entire market has improved, but definitely, if you look at it broadly, the market has improved. Our deal flow could be considered as a leading indicator of the state of the market. Our deal flow has definitely reduced.
Last question.
I have no comments on how the new COVID in the market,
But
right? Which is the Ukraine-Russian.
Anuj, we should use this platform where all the funds are there. Then we should ease the problem that Irfan has of reduced deal flow. We talked about co-investment, and I think the previous platform we were talking about fund of funds. So Irfan, if you can talk to the right thing, it may make a lot of sense. I think everybody else, Sharad, Nipun, and we can look at a situation where you co-invest with us into this thing, and we can actually make do that the overall return to the investor will be significantly better risk adjusted.
So
That can probably be a good takeout of this entire conversation.
And
definitely.
Also, yeah.
Sorry.
No, go ahead, Irfan.
So definitely, I mean, that's the approach we are taking to. So lenders have an issue in terms of seeding charge, and that was a big issue, and that was in fact we were wondering at one point in time whether to launch the fund or not without clearing that issue. We decided to go ahead because not everything can be solved with the same brush, but you try to clear as much of the problem as possible in any case. And we are glad to report that about 58 of the 108 deals we've done are where lenders have ceded charge. But that still means that there are a large number of deals which we couldn't do because the lenders were not willing to cede charge. And something that Vipul has suggested, another investor coming in and buying out the existing lender, etc., might increase the deal flow that way.
I wanted to comment. See, it's so interesting, the situation. When you had the best times, and we on this panel have been part of the industry for a long time, the best time was considered the late 2007 onwards to 11. Despite that produced the worst results for investors. And 2018-19, the worst times. And you add the blow up of NBFCs, the crisis caused by COVID, the worst time, I think, is producing the best result. So, the creation of the Swamih Fund, and credit to Vipul, he was part of that whole architecture to do that. And then the execution, the worst time, it's never been a better time. The industry, I think, for the first time in residential has never felt more confident, collectively as a sector, coming out of COVID, multiple crises, but coming out of it in this manner. It's a Houdini act. It's like somebody had told you in 2019 that this could be possible. And then there's this COVID when 10 months there'll be no construction, no sales, people will not go. It's when I'm hearing it and believing it, it's taking me time to digest also that collectively, if people put their minds to the problem, I think the government acted on time. A lot of smart decision making happened, and I think there is definitely maturity and more sensible things happening in the sector. Whereas back in the days, I think there was a lot of cowboyishness at that time. So clearly, I think looks like all the stakeholders have come together to create this environment.
Yeah. And
Thank
then Nipun, sorry, Sharad, go ahead.
saying is actually very encouraging. So it might get a little difficult deploying capital, but eventually the sector needs to do well. And if he's saying the deal flow is slowing down, and that we are seeing in our portfolios as well, that money is coming ahead of the time, say 70-80% of the portfolio, the money is coming much ahead of that time. It's actually encouraging. It will help the sector to come out of a really long 7-8 years of extremely tough period. And the unwinding of debt, and there is still a lot of overhang of the debt on the sector, and that might take a couple of more years, and then we can look forward. I also wanted to ask you, Anuj, because you are the closest to the ground as compared to all of us, given that you must be the largest real estate seller in India. What is the sense that you have looking at the residential market? We are looking more from a deal flow and our project.
So Sharad, we are certainly finding that the sales have improved dramatically, particularly for good quality developers. And when I say good quality developers, it's listed and leading unlisted developers. I don't think the market has increased as much as the share of this good quality developers, unlisted and listed, have increased. So basically, they are having somebody else's lunch. And that's where we are starting to see that this improvement in the sales, and this is what we're hearing from you, Sharad, saying is that the monies are coming back before time because sales are doing very well. And this is what we are hearing from Irfan, that we're not getting as much sort of deal flow coming in. But on the other hand, Sharad, there are a number of BC great developers whom you actually guys haven't funded, so you don't know what's going on there is. Their sales has come to an absolute standstill. This wasn't the case in 2000, Nipun, the period that you mentioned, 2007 to 11. At that time, Sharad, the buyer was not discerning. So they would go to the developer who was giving them cheaper, who was giving them 10-15% cheaper. Today, next door wall, one good quality developer is selling at 15-20% premium. You go to the buyer and say, why are you not buying it with this developer? Same boundary wall. He says, no, I don't want to buy it from this guy. I don't know whether he or she is going to be able to deliver it or not. I don't mind paying a premium for a good quality developer. And then you say, but there are all the regulations, there are all the compliances, there is RERA. I mean, the answer of the buyer is, so what? You're going to put the developer behind bars. I'm not going to get my apartment. That's where the segregation has really started to happen. And that's what, we are seeing. And hence, to your point, Sharad, you are starting to see money come back from these good quality developers to whom you had lent money or you had invested with them. Had you invested with the sort of C grade developers or B grade, I'm telling you, you wouldn't have got the money back.
Yeah.
Anuj, can I just add to that? Even with those developers, we are seeing, and to some extent, we like to attribute it to the Swamih involvement. But we are seeing, similar to what Sharad mentioned, we are seeing redemptions already happening with our investments. Money coming back in many of the projects. Now, I cannot share some exact numbers here, but money coming back in many of our projects that we had started about 1.5 years ago. To some extent, we attribute it to the market. To some extent, we attribute it to the alpha that we are generating as a credible funding source, and therefore buyers walking in and collections improving as a result of the Swamih improvement. But regardless of whether it's that alpha or the market beta, we are also seeing money starting to come back for us, which means that the cash flow position has significantly improved.
Good point. Nipun, last question. We're going to run out of time. It seems that everything's going on well within the Indian real estate, at least in the residential side. Seems that it is, in a little bit of a safe zone. From a private equity real estate, what do you think can go wrong from here on?
See, I think the geopolitical is right front and center. I think it's sitting right there. Cost inflation is already underway. One of my fellow panelists commented how the input costs are going to put an upward pressure on the whole situation.